Hi, I'm Darcie Crowe, founding portfolio manager at Crowe Private Wealth. Thank you for joining us today. We're excited to be hosting a new guest today for our Spotlight series, which focuses on highlighting best-in-class alternative managers throughout Canada. So it's not often that investors are able to get direct access to these management teams, so outside of pension plans and large institutions. So we really hope you find these sessions informative and giving you that inside access to leaders in the alternative space. So alternative investments are so greatly underutilized by retail investors in Canada, with the average retail investor having somewhere between 0 and 5% allocated towards alternative strategies. So as a comparison, this compares to over 50% for pensions such as the Canadian pension plan. So these investments have been fundamental allocations for institutions and family office investors for many, many years now. So we're really trying to provide education and to make increase participation, increase awareness of the space to retail investors, given the significant benefits they can provide. And we talk a lot about these benefits, but some of them can include additional diversification tools, uncorrelated returns. They can lead to reduced volatility and reduced drawdowns, and overall a much more stable, steady, and enjoyable investment experience. So with that, I'd like to introduce our guest today. So Jordan Snow is joining us, who is an associate director at Polar Asset Management Partners in Toronto. So Jordan's been responsible for product strategy and developments at Polar since 2017. And prior to that, he was an investment strategist for a family office responsible for hedge fund due diligence and portfolio construction. So Jordan, thank you so much for taking the time to join us and be here today.
Thanks for having me.
Okay, fantastic. So to start the discussion today, viewers may not be familiar with Polar, so we just wanted to start with a general overview of Polar Asset Management Partners. So if we can talk a little bit about assets that are managed, maybe the history of the team, investor base, things like that, just to get a good sense of who Polar is. And with that, we'll just pull up a couple of slides to talk to as well.
Sure, sounds good. So we've been around since 1991. We managed approximately $5.3 billion US. There's roughly 87 of us. 37 of those are on the investment team. 13 would be risk and technology development. We can get into our risk management and technology process as we speak further. And then the rest would be compliance folks, sales and marketing, administration, and other. We run a number of strategies within Polar, and our flagship fund is our Multi-Strategy Fund. That's where most of our assets are held. You can see from our investor profile on that page that the majority of our investors are pensions, foundations, and endowments. After that would be private wealth management, high net worth, and private banks. And then a smaller amount of fund of funds, family offices, and of course, ourselves, employees at the firm. Most of our investors are Canada. We also are increasing the geographic spread. We're trying to move a little bit more of our investor base into United States and Europe and Asia. We think that takes place over time, but Canada's our backyard. It's a bit of our advantage here in Canada from investing and capital raising standpoint.
Okay, fantastic. And
one thing I should point out.
Yeah, go ahead. Thanks.
Sorry, Darcie, go ahead.
I was just going to maybe bring up the
on
team
that page
as well, if you wanted to chat about that, show just the depth of the team as well.
Perfect. Yeah, we do have a team slide there. So that's an important slide. So we manage a number of strategies within our multi-strategy fund, as the name would imply. At the top there, we show convertible and risk arbitrage, fixed income, fundamental equity. We have a subsection called equity arbitrage as well, where we trade equity-like securities. And then at the bottom, what we have is a little bit more directional or opportunistic strategies. This would be Canadian event-driven, structured credit, and strategy development. Each strategy has a team. Each team has a lead portfolio manager, and each lead portfolio manager has a number of years of experience in that sector that they focus on. At the bottom, you'll notice a group of traders. And so these traders are dedicated to the fund. Some are dedicated to specific strategies. And so traders are to be in the know, they execute, and they support those teams above.
Okay, fantastic. Yeah, the depth of the team at Polar is certainly unique. So that's fantastic. So why don't we, the fund that I incorporate most into portfolios is the Polar multi-strategy, where a lot of the assets under Polar lie. So why don't we, start off by, how is it done? And it is a really unique return stream. So can we talk a little bit about both long-term, there's a really long track record, how the fund has performed long-term, and also focus on, given people are quite focused, obviously, on 2020 being a very volatile period, how is it done throughout that period in managing risk?
Sure, yeah, so we'll take a step back. Our goal is to produce an annualized return of 6 to 8% net of fees over a reasonable time frame, which we would define as kind of 3 to 6 years. So our 10-year compounded return is right around 7%. Our 5 and 3 year are right around 7 to 8% as well. So we've achieved that goal, but that 6 to 8% doesn't come every year. There's going to be years where we're going to underperform, and there's going to be years where we're going to outperform. And underperformance is typically driven by a poor opportunity set. So asset prices are rich, volatility is low, etc. So we like high volatility, we like market events. And so in March, as scary as it was for most investors, we were quite excited. We were able to go attack the market and put on trades that offered really strong risk reward. And so that doesn't mean buying an individual stock at a price that looks cheap. That means engaging in high quality securities, looking at those sectors and structuring trades in an arbitrage way where we can really decrease the downside risk in any one trade. What I will point to is some of the early years where the fund's composition was much different than it is today. It was much more classic Canadian hedge fund. There was less hedging, more directionality, fewer counterparties and prime brokers. And our relationships with our prime brokers and counterparties are very important to us. We have long-standing relationships. These are the banks and brokers that help us leverage our investments, help us trade, give us information. We've got 7 full-time prime brokers today. In the early years, we only had 1. That's a significant risk management issue when you have a small or single prime broker, small number or single prime broker. So we try to diversify our fund across multiple external counterparties and spend a ton of time due diligencing those counterparties, and they due diligence us. It's a two-way street in that regard. And what you'll see in the return profile over time is it's smoothed out, and that's not a coincidence. That's by design. And so we brought on a chief risk officer in 2008. Chief risk officer's name was Abdullah Rukin. Today, he's our deputy CIO. He came from Scotiabank. He had a number of years experience in a risk management role. And he built out our risk management technology development team. We've also diversified into more strategies. We've added more strategies into the fund, which has helped mute volatility over the years. And we've really grown our AUM and our investor base from some kind of high return generating focused clients and strategy in the 90s and early 2000s to a much more steady eddy, low vol, consistent return profile where we do step back and observe markets. We won't participate when the risk reward offering is poor. That would be like 2018. And then when things shake up in the market and there's a lot more interesting opportunities and value and volatility, that's when we put a little bit more risk on, when we're being paid well to take that risk. And so a great example over that track record would be fourth quarter of 15, first quarter of 2016. There's a lot of volatility in the markets. Some folks may remember a very large move in the oil price from 100, down to under $30 a barrel. That set us up to put capital to work as we were being paid much more than prior periods to assume credit risk, to assume certain arbitrage risks and equity risks. The same thing happened in March of this year. And so you will see a bit of an ebb and flow or a rhythm, if you will, to our return profile. And that's what we're trying to do.
Yeah, no, I think you covered it very, very well. And a couple of things. So one, obviously the volatility where it is now, it's about a third of what equity markets are. So it really is that, steady eddy return stream, and it's not riding the roller coaster, which investors really like. And secondly, as you know, in periods where volatility is low and everything's going well, this may not be performing the best, but everything else is, so you don't need it to, but it really steps up. 2020 is a great example. It's having a fantastic year when other things are not. So it's acted as a really great complement to portfolios in that way. So why don't we chat a little bit more about how you actually do it. So can you just talk about maybe give a breakdown of the strategy, the investment philosophy behind the strategy, and how you approach the management of the portfolio?
Sure. On that page shown there, you'll see obviously 7 different strategies. And those are categories. So within those categories, there can be one team or multiple teams. So within our fundamental equity category, we actually have 3 teams. 2 we've had for a while. One we just introduced into the portfolio in May. So that would be U.S. equity long short. That's a team in and of itself. We've got a North American microcap team, and we've got a global equity long short manager that we just house within what we call strategy development. So we've just started that. So that strategy would be small. We monitor it. We want to make sure it's additive to the portfolio. It has to zig when the other strategies zag. So it has to be complementary on a correlation basis. It also has to be complementary on a diversification basis. So what's interesting about our 3 fundamental equity strategies is across all 3, there's approximately 400 to 500 holdings, but there's very minimal, in fact, 0 overlap at times. So these are different thinkers, different approaches, trading different securities in different ways. And that's what we consider to be diversification, not just long a U.S. oil company and long a Canadian-based oil company. That geographic diversification doesn't do it for us. It has to be approach, security type, et cetera. And that would apply across some of the other strategy buckets as well. The 4 on the top are what we call core strategies. These trade large liquid markets. There's always something to do in convertible arbitrage, event-driven, fixed income, and fundamental equity. They're very large markets, as I mentioned. They're very liquid markets. And so we're always able to achieve a standard return. However, occasionally, one or more of those markets will set up quite well, and it will make a lot of sense for us to increase, or they won't set up well, and it'll make a lot of sense for us to decrease our amount of capital and participation in those markets. So those 4 are core. The 3 on the bottom are a little bit more opportunistic, and that's why we call them opportunistic strategies. While we're very choosy in what we do across the board, we're even more choosy in the 3 that you'll notice below, which would be structured credit. So you're dealing with liquidity risk. You're dealing with more credit risk. It's a little bit difficult to hedge, so you want to keep your position size as small and as nimble as possible. We've also got an other bucket, which houses our strategy development, as I spoke to before. And then we've got equity arbitrage, where we trade SPACs and closed-end funds and other things. And we only want to be involved in those markets when they're paying us well to take risk. And we will take our capital allocation down considerably when those markets are not offering a good risk reward. So much like you manage a large portfolio, you want to be diversified across different managers, across different security types. That's how we think. We just do that in-house. And so we're able to quickly allocate that capital. If you own a fund, sometimes you have to wait a month, or it's difficult to change, your mind too quickly because you want to stick with a manager over time. We can make very, very quick tactical decisions when the facts change, when the market changes, and the setup, makes sense for us to make those changes quickly. And so what we do over time, you won't notice dramatic changes from a week-to-week or a month-to-month basis. But if you look at our fund over a 3, 5, 6 year period, you'll notice that, in the first year I was an investor in Polar Multi-Strat, they had a higher allocation to convertible arbitrage. And in my 3rd year, it was quite low. So we're making those tactical moves on behalf of our investors. And Darcie, as you mentioned, most of our investors have large allocations to traditional assets like bonds and fixed income, a lot of pensions. So they really rely on us to do that work for them in that alternative, corner of their portfolio, if you will.
Yeah, absolutely. And I think that's a great benefit of the way you have this structured as a multi-strategy, is you guys have the expertise to be making those weighting tilts as you see the opportunity. So I think that leads great into maybe chatting about what you're seeing as the greatest opportunity today. What's working in 2020? What's the team excited about, and what might investors be able to expect over the coming 12 to 18 months, given that we are in a period of heightened volatility right now?
So I'm smiling because ironically, what excites us is what our investors hopefully don't expect, which is volatility.
Yeah.
Volatility works very, very well for us. It causes asset prices to move around quickly, and you get discrepancies between fundamentals and volatility, and that's what helps us the most. So there's a little bit of a short-term pain, long-term gain sometimes when it comes to that volatility. I'll reference 2 periods before March of this year. We had to take some short-term pain. The fund was down just over 4% in a month, and that's a large down move for us. That would be towards the upper end of what we'd ever want to see on a monthly basis, frankly. However, in that moment, that's when our risk management makes sense. That's when all that unallocated cash that we've kept on the sidelines, our low levels of leverage, our very liquid exposures, all help us rebuild the book and hopefully come out on the other end in a pretty nice fashion. In some cases, we've gone through those periods where we've actually been profitable in negative markets. So that can take place too. There's a little bit of a randomness to that, but it's a healthy randomness. And so right now, what excites us most is, knock on wood, volatility's back. Volatility was quite low. In fact, historically low on a long-term basis in 2017 and through to and that can dampen returns, and you'll see that in our return profile. So by volatility, we don't necessarily mean stock market volatility. We mean interest rate volatility, right? We've layered in some interest rate hedges into our portfolio in recent weeks, frankly, and it's tough to see interest rates moving higher. There's so much central bank stimulus. It would impair housing. There's a lot of risks that could come with higher interest rates. It could have a pretty negative effect on a lot of asset prices. And so do we foresee higher interest rates? No, that's not why we're layering in the hedges, but we do assign a probability that could happen. We're seeing some signs of inflation, and so we always have to be hedged. And sometimes those hedges are costly, just like home and auto insurance. Hopefully you don't need it, but that's why they're there.
Yeah. Okay, fantastic. And the SPAC space obviously has been a space drawing a lot of attention. Is that somewhere that you guys have been seeing opportunity this year as well?
We have, yeah. We view the SPAC space through an arbitrageur's lens. So SPACs, as of late, have been widely talked about in the media. They are attracted to these very kind of popular stories, electric vehicles, software, high growth. Investors, retail investors particularly, are participating in SPACs more than we've ever seen. We're seeing more equity long short investors participate in SPACs, and they are there for the growth potential. They're trying to find the next Tesla, if you will. Yeah. We are providing SPACs with capital before they become popular, and we're looking for a very steady return on cash. So SPACs raise a bunch of money and they park it in an interest-bearing account. And when we can purchase the value of that cash in the account at a 3% discount and apply 2 or 3 times leverage to that number, that's a good return for us. But when the SPAC turns into a new company and the stock price starts moving around in a very volatile fashion, we're usually out of the trade by the time that happens. We don't want that sort of volatility. So we used to be a pretty large participant in the SPAC market on a percentage basis. And that percentage has decreased as the market has grown tremendously. And that's actually good for us because we're a little bit more nimble than we used to be. There's more volatility because there's more eyes on SPACs. There's more diversification. So we've gone from 50 SPACs to 180 in the market. We used to own all 50 when there was 50, and now we own roughly 130 of the 185. So the market's gotten bigger, and we've gotten more nimble. And for us, we've been focused probably a little bit more on risk management in that book than we have in some time because of the added volatility. So it has been a good market for us.
Okay, and just the lastly on positioning, what would be the greatest tilt you have in the portfolio right now? I guess the one area, when you break out the 7 different strategies, what would be the greatest focus area that you have within there right now?
Convertible bond arbitrage. So convertible bonds are a credit security. They typically require credit work. However, we avoid poor quality credits in that book. We're focused on high quality companies, or we're not worried about any credit risk. We're looking to go long a convertible bond we're short the underlying equity of this company. And all we need to happen is volatility, up or down. They're both good for us. We just don't want to see that company get impaired because we own the credit. So we spend a lot of time focused on credit. There's really three drivers of returns for us in convertible bonds. There's equity market volatility, and that could be broad equity markets or single stocks. And single stock volatility looks like it's back. So if you look at the biggest moves in the stock market on a daily basis, you're seeing a lot of companies move. I mean, Twitter today, for instance, is down 20%, and Mohawk Industries is up 13, 15%. They make flooring in the States. So big moves across different sectors. That's what we like. So we want equity volatility. We benefit from new issuance. There's been a lot of companies looking to issue debt, either high quality companies that want to shore up their balance sheets right now, or lower quality companies, typically ones we avoid, that need capital to survive. And then you've got really high growth companies. So we're focused on pharmacy delivery, food delivery, these kind of at-home themes where these companies have to hire a lot of new talent to drive their products, to distribute their products, and they need capital very quickly. So they come to the market, we're one of the participants, and we'll raise money. So we've got volatility, we've got new issuance, and then we've got absolute cheapness. So converts, because there's a little scare in the market, unlike equities and bonds, which benefit usually first from central bank intervention. They get a lot of liquidity, their prices rise. Converts are kind of secondary to that. And structured credit would be third, right? So converts, even though they have spreads have come in, that is, converts have rallied since March, they're still providing wider spreads than they have historically. And so all three pillars for that strategy in terms of return generation are lined up. So we've got an overweight to that. We have 25% of the fund's capital allocated there. And that's a ballast to the portfolio. It's very uncorrelated to or low correlation, I should say, to equity markets. It has a tendency to be either down very small when the market, gets squishy, or even positive because of all the high levels of hedging we do in that book. It's very tactical. So it's a very interesting absolute return strategy, and it's our favorite at this time, I would say, on a capital allocation basis.
Okay, fantastic. Well, that's been a really great and informative overview. Why don't we just leave investors, Polar multi-strategy has brought in, significant assets. It's attracted attention of really key institutions, pension plans, family offices across Canada and the United States. So can you just leave us with a comment on why this is such an attractive strategy, why the smart money investors have really flocked to it, and why you think retail investors, might consider holding it today?
Yeah, I think there was good reason 5 years ago to think differently. Markets had rallied a lot. Bond yields were low. There was a good reason to add alternatives. Sometimes it takes a while for things to settle in, but I think particularly today, what was still true 5 years ago is even more true. I think it's time to look at alternatives. I think it's time to look at what can I invest in outside of traditional assets that's going to give not only a good, solid, dependable return, but again, that diversification, things that will zig when the rest of your portfolio zags, or things that won't surprise you when you look at your statement, right, that you provide your clients on a month-to-month basis. We would love it if your clients, don't really care about what Polar says this month, because it's always so steady, right? We're going for steady returns, no surprises, and that's what we're trying to achieve. So I think now more than ever, that makes a lot of sense. But I will say one thing on the asset flow: when you're managing, a ton of client capital, we manage quite a bit. You can't be aggressive in raising money consistently. You have to pick your spot. So we had a really good market opportunity in March. We still think the opportunity is strong, but you'll note that we'll probably slow asset flows here because we don't want to have too much capital to manage, right? You always want to be able to put more capital to work than you have, and that's the healthy place to be when you're managing capital.
Yeah, fantastic. Well, I think that's great. And that's the message that I'm constantly, trying to relate to investors. And I think there is this massive gap, particularly within traditional fixed income, that needs to be filled. So getting the, education awareness out of alternatives right now is something, I truly do focus on. So thank you. That was such a great opportunity to learn more about Polar's strategy and the investment philosophy, the team you have in place there. I truly believe in the current environment that these hedge fund strategies, arbitrage included, are going to play, a very important role in providing stability of returns and, uncorrelated return streams to clients. So I do need to reiterate, these sessions are to provide you with information. They're not a recommendation. If you're interested in learning more about Polar or hedge funds alternatives in general and how they might fit within your own portfolio, I would be pleased to speak with you further on that. So Jordan, sincere thanks to you for taking the time today to share your insights with us. I know how incredibly busy you and the team are. So thank you for your time, and I'll thank everyone else for tuning in. You can look out for upcoming sessions where we're going to highlight other best-in-class managers in different alternative spaces. So thanks again, Jordan. We really appreciate it, and have a wonderful day, everybody.
Thank you. My pleasure.
Okay, take care. Bye-bye.
You too.